folks. We might kick off. My name's Glynn. I'm the managing partner at TEN13. I'm very excited to be hosting today the journey of Steve Baxter as an angel investor. So I've worked with Steve, and he's been a mentor to me over the last 7 or 8 years of investing in my career. Steve's been a major supporter of the tech industry over the last decade in Australia. Really looking forward to breaking down wins, losses, lessons, and how I guess he has thought about investing as an angel investor over that period. And Steve's arguably one of Australia's super angels, and so really exciting to get stuck into it. But we'll kick it off with the fun part being a disclaimer. TEN13 is an authorized financial services licensee for wholesale investors, not retail. Everything shared in this presentation is personal experience of Steve Baxter or myself, Stu Glynn. Any content provided today is not advice in any form, and we recommend that you contact your own financial and legal advisors for any tax, insurance, and investment advice. This session is for informational purposes only and does not constitute any form of offer, and past performance is not an indicator of future results. Cool. So we're going to get stuck into it. So plenty to cover today. We'll give you a bit of background on us and Steve, like who the speakers are, the history behind the journey. We'll dive into key learnings that have been summarized over the years, and then we'll dive into some examples of the winners and losers in the portfolio over that period from an investment perspective. We'll try and keep the last 15 minutes for Q&A, so we can dive in. If you have any questions, please do just drop them into the chat, and we'll moderate and start I guess working through it on the back, so we can sort of let folks dive in and ask, do some Q&A towards the back end, and then a couple of things around resources at the end. For the starting point, good day, Steve.
Hey, how you doing? Thanks, Stu. Thanks for everyone for coming on board. I'm looking forward to see lots of faces in there I've seen before and some fresh ones. So yeah, looking forward to having a chat. Stu, as ever, has got it quite highly regimented, so I'm looking forward to walking through these slides. It's going to be good.
Sounds good. So just a bit of background on Steve, being the humble guy that he is. So Steve, I think most of what we're talking about today is going to be his time at sort of transition level investments, which is Steve's family office. He set that up post working at Google, but prior to that was the founder of 2 businesses that he exited. The second one being Pipe Networks, which was an ASX listed company that sold for around 400 million, and Steve was one of the co-founders. Post that, he went on to do a variety of things. He started his own family office, which is transition level, but very much a tech ecosystem supporter here in Brisbane in particular, starting River City Labs, Startup Catalyst. He was a shark on Shark Tank, getting his mug on TV. He was the chief entrepreneur for Queensland in 2018. And more recently, Steve and I co-founded TEN13 together about 3 years ago, which is a deal-by-deal venture capital firm here in Brisbane. And then more recently, Steve started a sovereign sort of defense firm called Beaton Zone Ventures. So lots of experience that we're keen to dive into. I won't sort of talk too much about myself, but I've basically been on the journey with Steve, helping manage his family office over the last 7 years. So we've taken those investments from, we'll dive into it, but I think when I joined, we had about 8 or 9 investments in the portfolio. Now we have about 78, and that's 110 different investment rounds over the years. So lots of follow-on funding. So some of the notable companies in there, Steve, I don't know if you want to call out any of these.
Also, no, it's the ones we've documented in our latest system and the latest CRM we've got. So there's probably another sort of dozen in there that maybe half of those Stu doesn't even know about, to be honest. So look, it's been a good journey. Started out as I was a twice-washed telecoms entrepreneur, I suppose. Really didn't want to run a business again, and I was very happy to invest my capital into backing other people and going on their exciting journey and living vicariously through them. Obviously, with transition level in TEN13, that is a business. I'm quite serious about that, but mostly Stu runs it, which is great. Still very keen supporter, and really prefer to be that capitalist and not the industrialist. That's for sure.
Yeah, and I think some of the, as you can see on the slide, I mean, we've just called out a few of the companies that have been interesting over the years, but we've had a bunch of companies, I guess, that have gone full circle. We'll get into a couple of examples towards the back end, but and when I say full circle, from investment through to exit and sort of being realized from an acquisition perspective, we've had a company IPO, a bunch of sort of trade sales, acquisitions. And so it's been great to be on the journey from first check to all the way through. And then we've got a bunch as you can see, we've got 3 companies that are valued over $1 billion at the moment. We've had, I think, 8 exits in the portfolio from last count, of a variety of sort of, I guess, like return multiples there, and then some that are tracking really well, you know, throughout the portfolio. And so lots of learnings along the way. So we might get stuck into it. So the first one, I guess, Steve, what did you do in the early days to kind of start, I guess, like start angel investing, start getting deal flow? Like how did you think about it?
So I'd actually been out of the country for a year working for Google, as Stu mentioned, so I had to come back and relight my networks. And so I started that process just by contacting people that I knew in business and had some respect for what they were doing. And you know, that then the obvious request came for participation at capital level, and I started doing that in some small ways. Ultimately, culminating the, you know, starting Recipients Lab was an amazing way to find deal flow. I don't recommend anyone start an off-profit co-working space to find deal flow. That's just crazy. I wouldn't do that ever again. But it was missing in Brisbane at the time, and it was quite beneficial. And then led on to me. I mean, the biggest thing I did to find deal flow was to put my face on TV for 4 years, to be honest. So not everyone can do that either. But through that process of Recipients Labs, there's a few things in here that I'll highlight. That is, bad deals are really easy to find. There's always a bad deal out there. The nice thing in the tech sort of software space, where there's lots of deal activity, you can just wait for a better deal. So no deal, you know, no deal ever has to happen. I'm a pilot. No pilot ever has to fly, and no deal ever has to happen. So the other thing is networking. The one thing I've found over the years is you've just got to get out there and meet people. And I've gone all across Australia. I recall going to Silicon Valley on my first visit just after Facebook. Facebook was about to list, and I went over with the company we'd invested in called Text for Coffee, which might give shivers down his spine when I say that out loud. But and literally, you know, it was weird. This was an Australian-based food ordering service, but unless you were a social network, no VC in San Francisco would talk to you. Literally, we just got the cold shot. Unless you're on the next Facebook, they didn't care about you. So that taught me a lot. It's a great place to go, but you know, there's a bit of a herd mentality. I think Stu's got some more structured stuff on this slide. I'll let him go. Yeah,
no, totally makes sense. Even on that Text for Coffee one, I guess, like, I can't recall how much you invested in that business, but like
600 grand.
Yeah, and then sort of didn't quite make it through. So
now that being said, look, I would
journey.
I would back that founder again. He's come up with something I didn't like, but you know, I'd definitely listen to him. And if he can't, I would. The fact that I lost $632,000, not that I'm actually hanging every dollar at all on that investment, I was fully aware of what I was doing. You know, I was backing him. You know, it was one of the sad stories there, because there was 2 founders, and then ultimately there was a friend that they were friends. That friendship busted up, which is not that uncommon, to be honest. So there was many years those guys gave it their best and just proved how hard that market that they're in was to penetrate.
And just a question on, like, I guess a couple of your earlier checks were probably higher amounts than you end up doing after, I guess, like a few years of learning. Like, what would be your take on sort of how you would start out? If you were to do it again, would you do the same thing? Yeah.
No, look, probably as I am now. So if I was to start out again, I had some very small ones early that you don't know about, Stu, that we just don't talk about inside our household, unless, you know, we have a pleasant dinner conversation. So, I mean, even Text 4, that was $200,000-300,000-ish checks. That wasn't 1-600. But the biggest first one would have been Dose Me, which we'll get to later. That was $500,000. I had a lot of conviction on that one, I suppose. I would start smaller, and we are now. Like, I'm contributing between 50 to 300 in deals, I would say. I think the average is, you might know the average better, Stu. I think it's around about probably high 170s.
Yep.
On a deal, on an early stage, you know, first round deal, essentially.
Yeah, 100%. And just from a deal flow perspective, but I guess like networking and things, but have you, I guess, like over the years, where have you found, like, I guess, any insights into where you built that deal flow? Do you think that is your take, build the networks and it sort of comes over time just by being active? Do you center in on building strong relationships with other VCs or like portfolio founders? Like, what's your thoughts on deal flow and sort of how to build that up?
I've found you have to get out there and network to get the deal flow, and it's the one thing that doesn't scale. You've just got to do it. There's actually no shortcut. Maybe putting yourself on TV, but I don't think so there, to be honest. That just got you more questionable deal flow at times, to be honest. So You have to get out there, you have to find people, you have to network like hell. We're all Australians, we're all, gregarious, and we like getting together and meeting people, at least I do anyway. So it's not that hard. But there's just a lot of, there's a lot of dinners and coffees that you have along the way, and events, sponsoring events, speaking at events. You do whatever you can to insert yourself into someone else's sort of thought process.
Yeah, totally. And moving on, one of the questions that we had, I guess, like who to back. And so keen to get your thoughts of how important the team is. We're generally writing early stage checks, like almost sometimes the first, if not like first investment or close to anyway. Over the years, like maybe give us a few learnings around.
Yeah, look, it's people. It's mostly people. The reason this is unfortunate, but there's a saying that these businesses mostly die from suicide, not homicide. So it literally is the people who run them tend to blow them up or hurt them. So we've learned over the while to if you have doubts about the people, you need to walk away. As I've got here, I think on this one, yeah, just learned that anything that smells like a lie, you need to walk away, because they don't get better. And you can, guys can sex up, or the team can sex up, or puff up what they're doing. That to me is, it's okay. That's marketing. But as out and out lies, just they don't tend to get any better. So it really is those teams. But at the same time, as an investor, you shouldn't be looking to tell the team what they can do. If you're going to invest in them because you think they're pretty good at what they do, probably better than you at what they do. So if you have to tell them what to do technically or commercially to some degree, then you're probably backing the wrong team. So you can't inject enthusiasm for a product into a team. They have to get you excited about what they're doing. If it's your job to get them excited, that's another reason to stay away as well. So that's why, I'm a capitalist, not an industrialist. I don't want to run these businesses. I really just want to back them and take the profit that way.
Do you have a take on, I guess, like age or sort of backing founders that are sort of new to an industry versus like very in-depth experience in a particular industry? So like, I guess, hungry versus the proven, like what's your... And maybe you can talk about catalyst, what you did in the early days there would be good.
Yeah, look, I prefer young, I suppose. So young and proficient, which doesn't mean they've been to university, but it can mean a whole bunch of things. Can they do what they want? Can they have the technical chops to do what they want to do? So that there's ways you can do that with doing things like increasing your network at the same time. So going to university, you could get the experience, the qualifications, and also a pretty good network. And a good example of that is a local firm, Tander, that started by 4 QT grads. But very early on, I saw that there was actually a confidence problem, I think, with young Australian technical people, and that they didn't want to actually think big, or didn't know you could think big. And so I started a program called Startup Catalyst, and where I took 20 of the brightest tech kids to Australia, every year to San Francisco for 2 weeks, and there was about 12 days in the middle of the startup weekend, and we went and visited the tech people at Google and Facebook and Twitter and you name it. We basically just went and visited every techie in San Francisco for 2 weeks, and really got them to expand their horizons. And my goal was to make them unemployable, have them come back and start a business, not go and work for the public service or back to the university or something silly like that. So but that's networking again, and once going to that amazing sort of hub, which is the Bay Area, which every cafe you go into, there's someone working on a startup or someone trying to close a deal or talking about term sheets. If you haven't been there on that sort of and done that sort of thing, even to Boston and New York, but literally go to these places where the activity is a lot more frenetic, and you sort of come away changed, to be honest.
100%. And what's your take on I guess tech talent? Generally, we're investing in software businesses.
With ChatGPT, you don't need it anymore. We just use ChatGPT to write all this stuff, don't you? Look, you need tech talent. You need gobs of it, to be honest. If it's a tech business, so whatever your technology is, you need that talent. If the founding team can't build the first prototype and maybe 3/4 rebuild that prototype into something better without external assistance, then that's probably a team worth walking away from as well. So unless there is an exceptionally strong technical capability to boot the product up and maybe to rebuild at least once without needing external capital to bring people in, then you've probably got the wrong team. Yeah,
I think over the years we've sort of learned this lesson a few times, and putting capital into a business that's got an agency building on the side. So we generally seem to err on the like the team needs to be able to do it. They need to have the resourcing in-house. We've sort of made that as like conditions of investment for some really early businesses, just to say, like, we want to see the people actually being able to help you build this, because we know what it takes, and your software product is never done. I guess moving on slightly, but I guess this is an interesting slide we pulled together of all of Steve's investing for a first, like, it was about 23 companies for the ones that we've recorded. You can see it on the right-hand side, which is basically the red is how much was invested, and the black is what that is worth today. And so you can kind of see, obviously we haven't sort of shown the index of what that is worth, but in short, there's a high level of concentration around a handful of arguably the ones that have grown to be the biggest companies, and is required quite a wide portfolio of investing to get there. So I guess, like, Steve, in your early days, like, how do you think about taking risk to invest in sort of early but high potential companies? There's lots of things that can go wrong, as we've seen over the years, but I guess, like, what's your learning, if you've got any thoughts on portfolio approach?
Yeah, a note here as well. I keep balking when I say this, but this is, in this game, you don't tend to see, if you see a return in the first 4 or 5 years, you're quite lucky. So hence why this sort of tops out at 2019. It's a vintage as a comparison. But on that journey, there were some really low spots where I kept thinking to myself, how much am I spending again? And why would I do this? Despite the fact you're getting these great paper gains, it wasn't until I actually started exiting out that you understand the reason for doing it. So, as you can tell by the number of companies in the portfolio, we took a very, very wide approach to that one. I think we've got some other stuff on following winners later on. I can speak to that briefly, but I thought there was another slide as an SG coming up about following winners. Look, it's important, but as an angel investor, you often get screwed. And we can probably, is there another slide with that one on this, Stu? Sorry, I thought there was.
This is the one I think you're talking about.
Might be that one. Yeah, so that's it. So yeah, we jump straight into this one, dilution. So everyone always talk, the big topical points of valuation, for example, and for investors is valuation, and in some respects for founders is dilution, which is, the opposite of valuation. So, and just because I think in this example, we're getting what, 1% in the early, we're getting 1% in the early, in this example, and this is not that uncommon, although 1% is a little bit low, probably more like a 10-13, given the my size of engagement in 10-13. But, and this is not that uncommon, but the things in here are like the ESOP has an issue there. Then sometimes you have founders who have to be re-optioned in order to actually keep them bought into the business as well. And then you often also get nailed out by later money. So if you may have invested and you may have 10% of the company in the early stage and you have pro rata rights, but if Sequoia is going to come along and invest $10 million on a $200 million valuation, and they want it all, are you going to stand in the way of that just because you have pro rata rights? So quite often, once the companies start winning, the sharp elbows come out and the angels get screwed, would be a pretty good description. It'll come down to the quality of founders, how well they fight for you, but are you going to stand in the way of their success because you just want to retain that? And so there's some decisions you have to make, and so the dilution's always, you always know about it, but sometimes galling. The other thing I'll say here too is, as a part of my portfolio here, we have a family rule that we don't put any more than $1 million Aussie into any one investment. Although we've broken that a few times, so it's not a good rule. But so that tends to be a limiting to the dobs of checks that I put in along the way, knowing that I'm going to top at $1 million Aussie at some point. So that's a little bit of an artificial constraint on some of the numbers you'll see. Let's choose how to present you. You're on mute too. That's $5.
Sorry, it's $5. So I think
that's $5 times like 180 too. So you're in trouble.
Got to work hard for some returns. But yeah, I think like the things we've learned is that, like, yeah, follow on is once you make a decision on every round. So like from a dilution perspective, but you want to own as much of these businesses at the end of the journey as you can. That's when it counts. That's when I guess the trigger happens in terms of a return perspective. So the example that everyone sort of uses, you could put 100K in, and this is just purely an investment example, not like an expected return. But there's the general theory that you put 100K in at a 10 mil valuation, and that company becomes a unicorn. It's like, okay, great, we think we're 100x. but you're not, because of these factors where it's, in every single round, generally what you'll see is you get dilution just from the investment capital coming in, which is arguably 15 to 20, 25%. But then you also get top-ups of your ESOP pool, which is, I guess, the pool to incentivize employees. So the next round of investor doesn't want to get diluted by this, so they'll say, instead of, you've already allocated out or issued options to a good portion of employees, so there's only a small pool, call it 5%. We want to see that topped up to 10% unallocated. And so therefore everyone across the whole board, that has ownership in the business will take another 5% dilution plus the investor capital coming in. And so dilution does impact you materially, because as you can see, we, like in the past, even with follow-on investing, like some of these charts will be closer to, say, 20 to 30 times returns, even though we have multiple sort of billion-dollar companies in the portfolio. So we've learned this across the board. Even with follow-on investing, dilution still has quite a major impact. And to Steve's rule, you can kind of see the companies where we've invested probably closer to $1 million, if not more, through Steve's family office portfolio. But then over the years, I guess even still, it hasn't sort of equaled out to that sort of general 100x return, which we'll get stuck into. Cool. What's your take in terms of the style of companies, Steve? So I don't know how if you think about this as does every company need to be like a 10x return, or do they need to have a shot at being what sort of breakout company, like we're calling it 0 to 1, or a market maker? What's your sense of the style of companies that have worked for you over the past, and how do you think about them in the early days versus I guess like a small contained Australian business versus this could be globally scalable, etc. Like maybe give us some thoughts around that.
Yeah, so I think like everything, the approach to this has matured over the while, and in our investment committees, we run an internal investment committee, as you can understand. We often talk about, given everything we know, what's the potential return on that. So we often look at it at money times return. If we ever made those returns, that would be fantastic. We always tend on the high side, but we're trying to classify what we should spend money on, and what we should invest capital in. When we rank stack, we might have 10 opportunities, and what do we proceed with? So we need some way to break those ties. So and there's a variety of mechanisms that Stu's team has codified, which is really good. So ultimately, what's the return? I mean, sometimes I get irrational. I just want to do it and say, look, we just, okay, whatever. I actually like this team. We're just going to do it anyway. It's my money. Please, chop, get onto it, I suppose. That's not very often, thankfully. So there's that there. So, but going into that, then is a whole bunch of other equations, such as, okay, so is this a market? Who's going to win this? Is this a case where there'll be like 3 big players or 1 big player? And so it's all the typical. Then what's the size of the market? What's the addressable market? What's the effective growth? Margins, for example, we can expect. So that all goes into, in my point, at the end of the day, we're looking at, aside from the emotional, where I just want to do it anyway. Okay, what's the possible upside of this? And we're going for the most potential money return. But all those other features, such as is it enterprise sales or B2C or whatever it might be, they all feature into that equation. And maybe Stu can speak to that equation more than I can, because it's just it's a large spreadsheet, basically.
Yeah, I mean, I guess like over the years, we've sort of tried to refine our understanding across all the different aspects, and we've broken down, I guess, when we do due diligence. But I guess as an angel investor, you probably don't, Steve invested early at transition level or TLI in building a team. So he invested in sort of, I guess, arguably me to join, and then we built up a team over time. And so not only was he sort of fronting up, I guess, investment capital, but also sort of, I guess, like the operational capital to actually get out into the market and source deals and do due diligence and things like that. And so rather than piggybacking, we were like, we're going to take a direct approach and build a team and then try and do our own due diligence on these companies. And so then we have a funnel of companies coming through. We basically build, like, I guess, like we call like a deal flow, and sort of we have a CRM and sort of rank stack all the companies as they come through, and do they fit into kind of different areas of, we'll talk about in a bit of like our own thesis, I guess. But yeah, we do the work, I guess, on the things that matter, which is one, very much like, do we trust this team? Do we believe in them? Or do we think that they can go all the way to build, a demonstrable sort of large business, I guess? Like, do they have the right level and mindset of ambition? And then we do the work around sort of other things, as we've noted here, but like market timing. Timing's very hard. It's one of the most important points, which is like, is there a lot of competition? Is there no competition? Is that because there's no market? Like there's a whole bunch, I guess, points that go into this. We do DD on the tech. We talk to their customers. We talk to other people across our industry. Even with like TEN13, we've got a wide network of investors. We often talk to underlying investors who have industry experience to try and tell us like, are they interesting? Or like, do we believe that what their product is, I guess like, do they have a chance in the current market, and what's good or bad about it? And I think the things that we've learned a lot about over the years is that most companies that you back, we see hundreds a sort of month, are high potential, great teams, etc. But oftentimes the things that impact them, you sort of get, I guess like sideswiped. So I'm not sure, Steve, if you want to talk about this, but any of the learnings or examples over the years.
Yeah, I think, yeah, that's a good, because harking back to the teams comment I made before, is that these things, business plans never survive contact with the customer. It always goes bad. And so when you imagine the founder standing in front of the investor saying, well, we said we'd do this and we haven't, we need more money, and if you're a mature investor, you expect that, right? But it does lead to a lot of stress in that relationship, and that really tests people, and it can actually, a lot of times unfortunately it doesn't end up with a positive experience for those founders. So so definitely, interpersonal things occur, but then there's just the straight sort of, global stuff we've experienced recently, like the absolute government overreach to COVID would be one of those in particular. And then, and we're still getting over zero interest rates, going to lots of interest rates in a very short period of time. So that's the latest thing we're dealing with right now at the same time. So we believe we try and invest through that as best we can, what we'll take into account. You can't pick those things. So you just sort of, put one foot after the other and off you go.
Yeah, play the game on the field. And the thing, like, I guess that we learned over the years, just watching the portfolio, is of, we get to work very closely. I think through River City Labs, we've invested in 30 companies through a fund there. We're at sort of almost 80 companies through transition level. A good chunk of those are in TEN13. So see under the hood of hundreds of companies, and the journey is never sort of linear. It's never like just up and always to the right. There's ups and downs along the way. There's things that impact them across the board, and sort of, I guess we were talking about it when we were putting these slides together, but just because you're down doesn't mean you're out. And like that's happened to a good proportion of our companies that have gone through tough times and then bounce back. And even Steve, maybe give the example of Pipe, like as you sort of mentioned.
Yeah, look, what the chat just recently, that prior to exiting Pipe Networks, I think we were at a $5.20 share price. We started a $200 million submarine capital project, which, if the GFC is 2 months away, don't do that. And we went to like a $1.60 share price within 2 months, and then 10 months after that we sold at $6.30. So the global wins are just amazing what actually happened. So staying in the game, and what I can speak that with one of the other companies there, which is Dose Me. I think is that slide coming up as it's due? Or?
Yeah, we'll pull it up in a sec.
Okay. But that was, it was a case of just staying in the game as long as we can, and ensure, trying the best to do the right thing by the company. But in the end, we were there when a person who thought it was more valuable than us walked in the door and wanted to buy it.
And I think that, like, oftentimes it comes back to the team, and it's just, do they have the resilience to push through, because the journey is super difficult. They're trying to change the world, bring their sort of product to market, etc., and sort of build, and just, I guess, along the way, the journey is just the journey, right? And it's ups and downs. And those people always, if they're there and sort of, continue building, then oftentimes the results come. We might keep moving. So how do you think about your own thesis, Steve? We've got, like, I guess, over the years, formed areas where we have tended to like investing in, areas that we've sort of erred away from. Have you learned some lessons on that? Like, what's your just overall thoughts around, like, sort of taboo areas that you just like, I don't like them for X reason, versus like ones that you do like? And
a few things, I suppose. I think that hardware is well named. It's very hard, and there has to be a really good reason for doing it when you have lots of other software investments in front of you. So they're not bad investments. They're just, in my opinion, there's better ones to do. This is the guy who just started a military sort of weapons-based fund, which is nothing but hardware. So I'm going to get taught a few lessons there, I imagine. The other one being, like, hype. I mentioned before, I was in San Francisco, and unless you were pitching a social network, no one gave a toss what you were doing. It was absolute. And I actually watched people who had nothing, a business that looked nothing like a social network, give an absolute social network tinged to their pitches. That was absolutely ridiculous. We've seen the hypes, we've seen the Web3s and the cryptos and all the rest of it. So there's lots of hype. We're entering another hype phase now, which will probably have a little more solidity to it, which is AI and generative AI in general. There might be a bit more to that one than the other ones. So I get very I get very confused when I see the hype cycle start. I tend to put my hands in my pockets in those areas, to be honest. And the other one is, from Shark Tank, I learned all about hula hoops and yo-yos and how not to invest in them, or why you shouldn't invest in more consumer-related things. So I find those businesses hard, once again, compared to software, which I'm much more used to.
Yeah, and I think like over the years we've sort of erred towards other ones, so like bottoms up software, which is like Clipchamp, or like a great example that's been built in Australia is say Canva or Safety Culture. We invested in Clipchamp and Drawboard in this category. Learning like things around plumbing of the internet, like API infrastructure, and how that sort of sits at the middle, the nexus between like connectivity between like old school systems and the sort of new age of technology. So over the years, I guess like we've sort of, when we look at companies, oftentimes you get your own pattern matching, you get your own kind of, I guess, areas of expertise and understanding, and I guess like where you want to place your own investment sort of capital. Not to say, so I guess like the takeaway from the slide is that you learn your own lessons. Once you get into the game, you start to see what works well, what doesn't, oftentimes. And we even did things like in the early days, we had, I guess, like an exploratory portion of capital every year, which is, call it like 10%, or what would it be, Steve? 10 to 15% or so, which is basically like, let's go and make some, build some relationships into the US. Let's invest into a couple of like companies through AngelList and through other platforms, and start building relationships there, or exposure to different markets.
That was part of the networking, right? We had to buy friends essentially in the large capital markets, and whilst they were good investments, there definitely were ways to ingratiate ourselves into larger investing networks.
I think the takeaway though, that is that as soon as we started doing that, we started to learn more about different regions and things like that. And now we have, I guess, a different view set in terms of some of the others, because we've learned some of the, like learned along the way, I guess, in some of the areas. So yeah, that was, so I guess like develop your own thesis is probably a takeaway from that slide. Maybe you can talk to a couple of ones, Steve, that didn't quite work out in your thoughts.
Yeah. So Maxwell, I actually seeded Maxwell Plus from what we call the post idea phase. And literally, I was having a beer with the two founders, or the two future founders, ruminating on a problem in the prostate cancer men's healthcare space, and booted up a way for using AI and medical imaging to find prostate cancer further. And we had a solution that works very well that no one wants to pay for. So that was a hell of a lesson, to be honest. I say I hate healthcare, but we made quite a few returns from healthcare, so I don't know why I hate it. But great co-investors there, main sequence. Everyone saw it. Everyone knows it works. It's just finding, in a country with a socialized healthcare system, no one actually wants to pay for it, and that's probably the worst part. So good healthcare system, but it's got commercial challenges in that respect. IncoDocs, it was accelerator team initially. So I came from the Riverside Labs Accelerator and really out to rationalise the world of international trade and commerce with respect to paperwork. Great co-investors in there as well, great team. Just really hard to cop traction and get that space moving. So, when you sit back and you understand about how, when you can't, the horse won't drink. You bring it to the water and the horse won't drink. So obviously, and actually the customers, they're not wrong, and you who are wrong. So at some point, things have to be dropped and moved on. But they did quite, IncoDocs there was lots of pivots along the way, great communications from the founders. We all knew the challenges they had and the problems they were having. There was no malice, there was no angry meetings. It was just, what can you do? If they're trying their hardest and they're the best at what they do, it's not a problem to be solved. That's the reality.
Sounds good. Yeah, there's just, as you can see on the slide, it's like, some of these, they've got great vision, great founders, some of the best investors or co-investors even within industry, etc., raised decent capital, and for a variety of reasons from a commercial perspective couldn't quite get there from a scale, product market fit perspective. And this happens in this space because we invest early before things are proven, and then you kind of learn those along the way. I guess on the flip side, there are some that work out. So we might dive into 2 sets of returns, then we're going to move to Q&A, and we've got a handful coming through. So,
so quickly, yeah, Dose, that was a big one, first $500,000 check. And then I actually invested to one of the founders who no longer wanted to be in the business. I sort of bought his share out for what ended up being a song for $100,000. But, helped him ease him out of the business, which was great. Put a CEO in. This is one of the ones you hold on till the end. They were commercially finding no traction in Australia, found better traction in the US. Not enough, but in the end, someone came along who had a bigger vision than us and overpaid. God bless them. So and that's what this game is about. You have to be on the ground. They had a really good product with pretty good distribution. It was just struggling to find that sort of that revenue, and it was NASDAQ listed company. Tabitha Russell came along and said, "Thank you very much." And so that was a fantastic outcome, and pretty short actually too. That was less than 5 years when it's due.
Yeah, it was
4 and a bit years. Yeah. Which is actually quite short for that level of return. It was quite pleasant. On ClipChamp, you love ClipChamp. Could have invested really early. Could have invested 2 rounds previous. I would have made a bit more if that was the case. But you make your decisions. But Alex and the team just smashing. They haven't pitched me. I had numerous problems with the way they were deploying their technology. It was basically malware, to be honest. Great technology, but poorly deployed. Then a couple of rounds later, they actually came back at a really positive outward building approach that was quite nice. It was bottoms up. So I had I think when we invested here, there were 6 million users, I want to say, by the time we got to them. Bugger all revenue, but 6 million users.
I think it was like 1 million, but then they got 6 million in like a year.
Yeah. It was all pretty fast. So when I saw that progress, literally I picked up the last part of a little angel round they did. Then we did a couple other rounds on top of that as well. So including one of the ones into TEN13, which was I think it was a 20-month exit for about a 5x return for the TEN13 investors.
I think the interesting one with this was that, they pivoted to their product that was inevitably successful in the end was an online video editing product, but that was their third sort of product, I guess you'd say. And then when we invested earlier, when they had the vision of that product, but we hadn't quite built it, but they were a very solid sort of technical team. And they just had this ticker on the wall of I guess number of users all around the world next door to River City Labs. And we'd see them every day just going, they just seem to keep growing. They're doing something right. But then we tried to take them out. They'd launched their sort of new product, but hadn't quite got a huge amount of traction on it just yet. They had a lot of users on a lightweight product, but they had built a more fully featured video editing platform. And they went out, we talked to a lot of the venture firms around Australia. We put them in touch with everyone, and we tried to raise 5 million, and they're a post-seed round, so / Series A, and we just didn't get it done. So Steve, basically we had asymmetric information and had to decide whether we should follow on. And to his credit, we put forward the opportunity and said, look, I think we should do this. And Steve fronted up with 800K plus, and we had a couple of other follow-on investors, which is about $1 million on that round. We joined the board, and then from there, they had Tola, which is a Seattle-based venture firm, reach out, just sort of cold, saw they were getting a huge amount of traffic. Within a year, they raised close to 10 million US Series A. And then as they were running their Series B process about a year and a half later, then they opened up a dual track process between whether to raise more money. And we were should we say standalone, and the board sort of decided, I guess, that the Microsoft interest was the right interest. And so crazy now. Basically this company is based in Brisbane, product led. Talked to Alex the other day, and they now are the default editor for Microsoft or Windows. Basically when you think of iMovie on Mac, that's what ClipChamp is. To over 1 billion sort of users. Microsoft has 1 billion plus users. I'm not saying that they have all of them, but they have amazing distribution now. They're scaling up materially, and that whole team is still intact and sort of building there. And it's was based with 95% of their team in Brisbane. So awesome. So I think the first acquisition for a Microsoft company, or a company by Microsoft of an Australian firm, and obviously Steve did a return there of close to 15 times, and that was in less than 4 years. And DoseMe was 23 times. And so I guess when you think of the portfolio, there's obviously a bunch of investments that we made that didn't quite work out or are still going. We generally expect I think I saw a stat the other day that the average direct consumer business is takes 8 years to exit and 11 years for a B2B SaaS business. And so, it takes a long time to get to these sort of results. And these ones have come out of sort of sideways, I guess, but you generally can't pick them. And, we never sort of set out to say, hey, Tabula Rasa would buy DoseMe. We didn't even know who Tabula Rasa was. So we never, I guess, arguably set out to say those companies were the ones that will be acquired or will be the acquirers in the end. But, I guess like they have their own strategic rationale and move on. So, I guess the returns have sort of speak for themselves over the time and sort of paid off, I guess, a lot of the work over the years to actually get them. And we've got other companies that are still going that are continuing to grow and building out, on the portfolio. So exciting journey. We might wrap up there and open up for questions. We've got a bunch that have come through.
All right, Josh, how do you handle investment decisions if you're thinking backing potential competitor? Well, we actually clear that through. So we try really hard not to back competitors of other investments. We have done that, and we've done that with a lot of consultation with respect to the current portfolio company. So in this game, you live on trust. You just can't go do that. A lot of times people will pivot into, they'll pivot and overlap. That was, post our investment, so it's less of our problem, to be honest.
Yeah.
How do you undertake DD on cross-border investments in Africa, Asia, given the geopolitical environment and significantly different to the local? It's not as hard as you sound. I think Stu can probably talk to this better, but I mean, the world of Zoom makes life easier. Trusted partners is one way to proceed. The fact that many of these businesses are actually domiciled in rational jurisdictions is actually quite good. Stu might have a few more words to add to that.
Yeah, sure. I'm just confirming the share is gone. Is it just us speaking? I think, look, I mean, I grew up in Zimbabwe in Africa, so we had more of an affinity there. We've made 5 investments into Africa through TEN13. I guess like over the years, we had a small investment in a company called Chipper Cash that started to go well, and we started exploring the region, and we sort of built a thesis around it, but we also started building relationships. So we have a lot of relationships with smaller venture firms on the ground there that we do a lot of DD through. They often, we co-invest with them, so we sort of get some alignment and make sure that we're comfortable. We have, what else do we use? Like we've got a bunch of folks from growth companies that are within tech companies there on the ground saying, have you heard of these people? Do you think it's a good opportunity? If it's, most of our deals have been in financial technology, fintech. So we sort of have built, like, I guess, a deep network of, say, Flutterwave is one of the biggest, it's a $2 or $3 billion company. We know the guy who's head of growth there. We know the guy who's head of platforms at another part of the business. So basically we sort of, have a very lively WhatsApp with a lot of folks that basically let us sort of do the due diligence as we can. And then we also get to understand, I guess, business models, who the players are in the market. It's just time and market that you sort of start to form out, the who's who of what they're doing. But again, it comes down to spending time actually building relationships and being in the market. And if you're not, then if you're just classified a tourist investor, you can get sort of undone pretty quickly. So we invest in the areas where we want to spend time, but oftentimes there's also business models that are ported, that have done well in other markets, and do we think that they're going to do well in that particular market? And so that is another thesis that we spend a lot of time on, which is effectively what are markets that have, what are business models or companies that have done really well in certain regions, and then we expect will come and do well in a particular region. So.
Right. Okay. Having invested in 100+ deals, what has changed in the criteria you look for before? Thanks for that question, Pete. Look, I think that the criteria hasn't particularly. Probably after the 6th deal didn't really change. I learned very quickly it was about team. That's sort of a gateway decision. It's a blocker. If you don't like the team, if you don't think they're capable, if there's honesty issues, you back away. That hasn't really changed. More recently, it's refined. It's been more sophisticatedly refined into a return matrix that allows us to make this, because we get presented. I get presented with maybe 10, 15 investment opportunities a month, which are brought down to 1 or 2. So we, Stu and his team have all the things he spoke about before. We boil it down into what's a better return, what's a better. And sometimes I have irrational. I just want to back that, or to Stu's chagrin, will refuse to back something that looks particularly good to him anyway. So yeah, so it's still about teams. So probably the big thing that change, but we have more sophistication around our decision matrix would be that one.
Scott asked a question about how do you test if those entrepreneurs are sort of have the right, first-time founders have the entrepreneurial gene. Like, how do you think about that? Or like,
look, it's a little hard to tell, you know, to be honest. But you know, Zoom's a lot better, but it's also harder for that sort of thing at the same time. I would say that at the moment you get a bad sensation, you walk away. We saw a business that we ended up handing money back on, for example, and that was just a litany of just really bad situations. That was the MF one, Stu. Which doesn't stand for mother, you know what, it stands for something else. But you know, that was like, I'm like, no, God, that's a sign, walk away. And over the next few days, the team did the right thing, just try to understand it. It was just a cascading series of crap turned up. So as soon as you get a bad spidey sense, you just walk away.
Yeah, and I think that comes to due diligence, but also just sort of eyeballing those founders and spending time with them, and you start to see, you know, just things like responding to you, like how much detail have they thought about it, etc. You can pick it up quite quickly on like.
I'd like to have a more sophisticated response, but what we're now seeing 240 businesses a month, Stu. I don't know how many would have seen over the last sort of 7+ years. It'd be horrific. So a lot of people use the term muscle memory, which I hate, but I understand it. You get a real muscle memory for this sort of stuff, which is a bias, but nonetheless, it's, you know, it's informed from history, right?
Yeah. Changing track a little bit, Josh has asked about whether you can speak about any Oz companies or Oz SaaS companies that have grown well into international markets. Like, what are the pitfalls? Any thoughts on those journeys? Like, we've been very close to companies like Go1 and Mr. Yum and others as they've sort of grown out.
Look, I think I say this a lot, and so if you've heard it before, I apologise, but Australia's a small market, 0.7-0.9% of the world's GDP, depending which number you use. Get out if you need to we're going to make a global impact. You have to get out and sell elsewhere. If you're thinking about the US, stop thinking about it and just go and do it, because you will fail on your first 2 attempts. If you plan for 9 months, you'll still fail on your first 2 attempts. If you plan for a week, you'll fail on your first 2 attempts. So the only thing lost there is time, because your product and the way you deliver it and your team has a nuance in that market that's not in Australia. So I think the best I've seen is someone only get it, you know, take 1.7 attempts to get it right, not 2 attempts to get it right, 3 attempts to get it right. So I always say, just get over there, learn now. We're investing for a reason. The risk is worth the capital you'll apply to that lesson.
Yeah, I think that like we found that generally the companies that go international quicker and try and take that on have proven to build, I guess, like larger business. It sort of obviously makes sense that they build larger businesses, but they actually have tended to succeed over time. But like you do have to go and take the capital and put it to work. And I asked guys like Andrew Barnes, for instance, who's the founder of Go1, like, would he do it again or would he do it differently? And he just said, you can't do it without learning the lessons. Like, you have to learn the lessons. You take the capital, you try to go to market in a certain fashion. And then if you don't learn, then it's on you. But then if you do, you know, now like the US market is their biggest market, it's fastest growing for that company. But, you know, it probably took them 3 times to find the right sort of go-to-market strategy, build the right relationships in the market, have the right team on the ground, like those type of things. But I think that like also there's been some amazing stories of like just software business or SaaS businesses in particular ground up, and, you know, talking to some international investors just this week, some of the most, like a couple of very notable VCs, and they think like Australia is the best in the world for, say, product-led software. And there's companies that have come out of there, but there's been Canva, Safety Culture, Employment Hero. There's a handful of really big names that have actually been built. And so there is a view, you know, externally that there's been great products being built in the software space that have come out of Oz. And so yeah, I guess like we, you know, that's an area that we spend a lot of time, and we sort of, you know, look out for businesses that are in, you know, fit within that category, you know, often, and at the early stages anyway, and see, do they have the opportunity to sort of, you know, to scale internationally. Steve, I'm not sure if you thought about this, but Scott asked the anti-portfolio. So any big regrets on companies you saw but didn't invest in?
Well, I was there in Perth at Ocean Beach Yacht Club, whatever it was called, when Mellon was pitching Canva and literally could not get into the circle. Literally, you physically could not get close enough. And at stage hadn't built Canva. They had there was their business, their project, scrapbooking business, excuse me, their online scrapbooking business. And they were pitching a really good pitch, to be honest, but you just could not get close. And you know, I was so obviously a lot of people who did very well. So I'm not disappointed, to be honest. I'm not sure I would have invested knowing the stage they're at, to be truthful. So maybe more for me. Well, obviously more for me. There's others along the way that you might have heard of. You know, the defence space, there's a business called Silentium that I saw like 6 years ago. And I literally thought to myself, I should change my mandate to invest in hardware. This is amazing. And I didn't. And those guys did not take any investment and now kicking it out of the park. So, you know, the ones
companies like Tanda, Steve.
Ones we couldn't get into, like Tanda. Oh, actually, we could have actually at one point, very, very early, we could have got into Tanda, but I'm not too sure. I actually think in that case, an early investment would have changed the complexion of that company. So I'm not too sure they would have been successful with investment, in all truth. But they're a bit of a, they're a bit of a, you know, they're very rare beast. So you can't think too much about it. You know, I'm a huge fan of the, you know, the butterfly effect or chaos theory, that if you change one thing in the past, everything else changes. And so it doesn't matter, right? You just look at what's in front of you.
And I think something that we think about is that, like, are we seeing all the companies? Like, that's actually like a metric that we want to track, which is like, if we're not seeing all the companies and we see, say, seed announcements that go up and we didn't even see it, then we're like, we're not feeling like we're sort of active enough in the market. And so, you know, you want to have anti-portfolios because it means that, yeah, and, you know, you have a thesis, and there's been ones where we've passed on businesses, they look like they've been a darling and hasn't worked out as planned, and they sort of no longer a darling. And then there's been ones who've gone on to be super successful, but then, you know, as long as we hit enough successful companies ourselves, which we've, you know, arguably managed to do with some great names within the portfolio, then it sort of works itself out, I would say. One other question from Stu around whether we do a lot of networking with venture capital firms for like offtake, or for like, you know, our companies getting funded into the future. You can talk about that, Stu.
Oh yeah, I mean, definitely. That's I'm an early stage investor. My biggest check's $1 million, right? You know, my biggest total sum of checks is $1 million. So, you know, these companies are going to grow and require growth capital, and especially until the last sort of 5 or 6 years in Australia, where there were far fewer options for growth capital in Australia. You know, 5 or 6 years ago, you had to go into North America to do that. So, you know, so first went there in 2010 or 11, whatever it was, when Facebook was doing their thing. And I've been back at least every year since, if not probably multiple times a year. You go, you visit the people you know before, you ask for more introductions. You're an Australian, just go and have a beer with them. They did love that. It's a bit unusual for Yanks. So, and you push out. You know, I've gone to almost every. You know, I've done everywhere except Boston. To be honest, New York, San Diego, LA. So, you know, I'm heading off to Omaha, Nebraska. I'm not too sure that's a VC, but that's, you know, it's Warren Buffett, Berkshire Hathaway in May as a part of the Jetstream mission. And I'm sure there'll be investors there that we need. It's that one. You have to drive up with one person to find. You have to drive up a lot of gullies to find water, right? And that's the job of networking. It doesn't scale. You just got to do it.
Yeah, and I'm looking forward to Jetstream. It's taking about 15 to 20 of our investors over to go meet up with a bunch of, I think, about 30 different venture firms and angel investors and other really awesome folks on the ground to sort of have an immersive week on the ground. Tim's asked us about, do we have any insights into backing solo founders versus a team, or, you know, what's the recipe there?
Have we?
We've backed a handful of solo founders over the years.
Tim,
I think, like,
but we it's a big point of discussion. I would say it probably acts as a decrement in the decision matrix, to be honest. So to get through that, they'd need to have a lot of other things going for them. You know, some actual traction they've made by themselves, and they've actually got a team around them, but they've actually employed them, so they're non-equity involved in that business, which was definitely the case with Tim. We have, but it's you know, it's tough. It's you know, it's a team sport.
Yeah, I think just having people to lean on, you know, as we sort of mentioned, like the journey is a long road, and it's always helpful to sort of bounce ideas and have someone inside the tent. But in that sort of scenario, that I think Steve's referring to Tim from Boutique, but then we also thought that Tim was very strong on product and technology, and so we had someone we had worked with a lot in a prior business or portfolio company of ours, and knew him pretty well, and said, "Look, would you be happy to take on a COO who's been awesome as like a right hand man for Tim over the years, called Chad."
Well, it was actually one of my other previous investor portfolios as well. So he came out of the portfolio into that business, which was great.
Yeah.
There's a follow-on question here from Steve Hunter. So what is the weighting of financials versus idea/team when making your investment decisions? And then a subsequent one from Paul, you know, if you had to pick one reason of the investments you made, what would you sort of pinpoint market, idea, solution, problem, co-founder, tech, purpose?
Or I'd go with traction. I don't know. I can't. So traction to me is it's multiple things. You know, if you've got profit, that's a great traction. You probably don't need an investor if you've got profit. Revenue's not bad. That's obviously a demonstrator of traction. With Clipchamp, it was users. It was accelerating by God knows what, probably 10, 20, 30% a month of the user base. So we saw that traction and thought you have to look to monetize that traction is especially with software, which is so repeatable and has such a low overhead once you get it right. That traction is very important. What was the question before that, Sophie? The first part?
The weighting of financials versus an idea team. So I guess financials captures the traction. Is it 50-50?
Well, you know, if they have actual financials, it's great. If they're projected financials and they're like a fairy tale, and you can somewhat ignore them, to be honest. So if it's actual financials, then that's pretty cool to look at. I mean, you know, Stu's got a finance background. He'd love that. He loves going through spreadsheets. So look, it's rare you have ones that you can depend on, I would say, if you know what I mean. Although that early that you know, that if you 50 grand a month in revenue is fantastic, right? But it's still pretty early. So the changes in that can be quite severe. So yes, if they've got financials, then we do a lot of work on that. That's for sure. And it does weight quite heavily, especially what we back for the most part, if they've got traction, is the degree of growth. What do you call that? The trajectory, excuse me, of the traction. It's about backing that trajectory. What are they doing that's working to get so many people to engage either with their wallet or with their time in that business?
I think we've got probably one last question. So I think from Jeremy, so he's asked, like, current layoffs in the tech sector affecting your investments, but then also, do you think, which is probably more pressing, it's a good time to invest given I guess resources coming, like I guess the lower cost of resources, but also more investor friendly terms to be expected? Like, what's your take?
Yeah, I agree. Yeah, lower cost of resources, more investor friendly terms. It's a cycle. Things go up and down. We made a decision at TEN13 at the very least to try and invest through these cycles to be a dependable sort of player in the market, so people come to us. So which means, you know, you take your goods with the bads and they average out over time. But yeah, no, amazing companies were built in downturns. We used to have an entire slide on the TEN13 pack about just these amazing companies that were born or at least grew through these stock market hiccups. So yeah, very much so. When we invest in that, we typically follow on other investors. We invest in a market and someone else has set evaluations. We have to decide whether we want to participate in that valuation or not. We rarely, probably 3 or 4 times we set a valuation. It's not very often. So we usually come in behind somebody else.
Yeah, I think it depends on the stage, but yeah, in short, I agree. I think we're trying to push through, you know, I guess the cycle, but we are starting to see sort of, I guess, like a more, I guess, like arguably favorable set of terms starting to emerge. It hasn't impacted too much at seed stage, given there's different dynamics around, say, dilution of founders. Like, you usually think about 20% dilution as part of a round. You're not going to change that, but the multiples of, like, definitely further stage rounds is where things like your financials and sort of, you know, all the.
And you usually find when the growth rounds where the big funds get a little more harder for them to do that, they usually come down to our territory and come back into the seed space, right, in order to find some value, basically. So a lot of that money crams down in these times. It keeps valuations higher than we'd all like them.
Cool. So we might wrap it up there. I think if people are looking to getting started into investing in early stage technology, you know, as we've sort of gone through, it's relatively high risk, like it's time intensive. But if you want to start getting, you know, more learnings about it, things we recommend across the team, podcasts are awesome. 20 VC sort of interviews a lot of the venture fund managers all around the world by Harry Stebbings, and Invest Like the Best. There's a couple of great podcasts there. You know, if you're into reading, Angel by Jason Calacanis, who are actually going to be presenting to us, like when we go over with all of the folks on this Jetstream trip, and David Rose, who's, you know, a very avid sort of angel investor over the years. There's a couple of books there. And then I'll note the sort of conflict, but TEN13 is a deal by deal venture firm. We have about 500 investors that join us and co-invest with us on deal by deals. Other platforms in Australia, you can get access to Startup Galaxy and Aussie Angels. And then more internationally, there's folks like AngelList. And this is a way to kind of get in with smaller checks alongside other managers and other folks that are sort of doing a lot, arguably outsourcing the work and doing a lot of the DD. And then you get to make your own decision from an investment perspective. There's some great venture firms based in, I guess Australia and wider. If you want to sort of have a a vetted portfolio approach, then you can look to back sort of venture firms. And then the last one, which is the original way that we went about it, which is just direct, and that's effectively building out, I guess, your own sourcing, going out meeting up with founders, going to accelerated demo days, just building up your own, I guess, a network of investors, and we see a lot of folks doing this. And so I guess like over the years, we're hopeful that what we shared today, and Steve sort of gives you some insight into the way we've gone about it, of deploying capital into the space, but lots of learnings, lots of stories over the years, but in general, we're very positive about I guess the way technology is impacting, and we continue to believe in that. So we'll continue to stay active and push through.
So with that, look, I get asked a lot about from entrepreneurs or wanting to be entrepreneurs, what's the hardest thing? I always say just starting, and then all your problems start after that as well. But literally, unless you start, you have to get that going. I would say the same thing about being an angel investor. I don't recommend you do it frivolously or without information. But there's plenty of books you mentioned there. Angel, another good one is The Hard Thing About Hard Things, and Venture Deals as well, which is they're pretty good intros for that. So I would recommend start small. If you want to see how frenetic it can be, come and join us in San Francisco. At the very least, you'll come away with a cracking hangover, but you'll meet just a whole bunch of really good people, right? So and we'd have just met the most amazing people. That's where the network building starts. Network building doesn't scale. It's hard. It takes effort, and you never stop doing it once you get to this game. So thanks Stu and Sophie for setting this up.